Hey everyone, welcome back to Corporate Decoder. Today, Relativity Acquisition Corp ACQC just filed its quarterly report for March 2026, and I am seeing a cash crunch that actually matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This SPAC is really feeling the pressure to find a deal before its deadline, and you can see it all over its balance sheet. Relativity Acquisition Corp. Condensed consolidated balance sheets, Scroll. Alright, let's dive into the numbers. We are looking at the condensed consolidated balance sheets for Relativity Acquisition Corp. As of the 31st of March 2026. Right away you see a couple of key things. First, their cash situation. They have only $5,071 in regular cash. That is incredibly low. For context, back on the 31st of December 2025, they had $7,140. So their operating cash has dwindled even further in the first quarter of 2026. Now, they do have cash held in the trust account, which was $712,789 as of the 31st of March 2026. This money is set aside for a business combination, and it is not freely available for day-to-day operations. Looking at liabilities, total liabilities are $3,927,905. A big chunk of that is warrant liabilities, which were $525,255. Here is where it gets particularly interesting with the class a common stock subject to possible redemption. As of the 31st of March 2026, they had 55,901 shares of class a common stock subject to possible redemption. This means shareholders could get their money back. The redemption value per S-share was about $11.57. Compare that to the 31st of December 2025, where they had 62,488 shares subject to redemption at a slightly higher $11.69 per S-share. This shows that even more shares are being redeemed, reducing the pool of shares that are not redeemable and freeing up cash from the trust account. Total stockholders' deficit is a negative $3,847,789. This is a significant deficit, reflecting the accumulated losses of the company. Now let's look at the results of operations. This tells us how the company performed financially over a period. For the 3 months ended the 31st of March 2026, the company had a net loss of $19,761. This might seem small, but it is important to see what is driving it. General and administrative expenses were $266,935 for this period. These are the costs of running the company. Things like salaries, rent, and other operating expenses. Remember, this is a SPAC that has not yet completed an acquisition, so these are primarily overhead costs. The big swing factor here is the change in the fair value of warrant liabilities, which added $242,715. This is because the warrants are marked to market and their value changes. For the 3 months ended the 31st of March 2025, the net loss was much larger at $463,778. Their general and administrative costs were $293,991, and they also saw a change in warrant liability, though this time it was a negative $175,077. Meaning the liability decreased in value, which helped reduce the net loss compared to the previous year's operational loss. Let's look at the earnings per S-share for the 3 months ended the 31st of March 2026. The basic and diluted net loss per S-share for non-redeemable class a common stock was effectively $0. This is after accounting for the share count for the same period in 2025, the net loss. Per share was a much more significant negative 11 cents, $0.11. So, while their net loss is smaller in 2026, the impact on earnings per S-share is less pronounced due to the changes in the number of shares outstanding and the redemption activity. The cash flow statement is critical for understanding where the company's cash is coming from and going to. For the 3 months ended the 31st of March 2026, net cash used in operating activities was $5,059. This means their day-to-day operations consumed a small amount of cash. Interest income on cash and investments held in the trust account was a negative $5,139. This sounds odd, but it is an adjustment to reconcile net loss to cash flow, and it reflects interest earned on the trust account. The change in fair value of derivative warrant liabilities used $242,715 of cash. This is a non-cash adjustment in the operating section, but it impacted their reported cash flows. Cash withdrawn from the trust account in connection with redemptions was a significant $83,659. This is a direct outflow of cash from their business combination funds. Financing activities show a net cash usage of $83,659. This is largely due to those redemptions of Class A common stock. The company is a blank check company, a SPAC, formed to find and merge with another business. They have not started any real operations. Their main goal is to find a business to combine with. They had their IPO back in February 2022, selling units made up of stock and warrants. It is important to note they extended their deadline to complete a business combination multiple times. They originally had until February 2023, then that was pushed back. Most recently, they extended their deadline to February 2027. This has happened through a series of stockholder approvals and sometimes with money from the sponsor to extend the time. The company's ability to continue as a going concern is indeed in doubt. Management acknowledges this, stating that the liquidity condition and the mandatory liquidation if a business combination does not happen raise substantial doubt. This is a big warning sign that they might not make it. This section details the initial public offering, or IPO. In February 2022, they sold 14,375,000 units at $10 per unit. This included units sold to cover the underwriters over. Allotment option, the net proceeds from the IPO and a private placement were put into a trust account. That amount was $146,625,000. This trust account is meant to protect investors' money until a business combination is completed. The shares of Class A common stock that were part of these units have a redemption feature. This means shareholders can get their money back if the company liquidates or if a business combination doesn't happen. This is why those shares are classified as temporary equity, meaning they are not part of the permanent capital structure of the company. Here we see transactions with parties closely connected to the company, like the sponsor. The sponsor initially bought founder shares. Then, in early 2023, they converted these Class B founder shares into Class A common stock. This conversion resulted in some transfer restrictions and waivers of redemption rights for these shares. There are also promissory notes with related parties. For instance, a note with Instinct Biotechnical Company Pte Limited. They had an outstanding balance of $433,190 on this note. These notes are usually non-interest bearing and get repaid when a business combination happens. If not, they can be voided. You also see mention of working capital loans from the sponsor or affiliates. These are meant to keep the lights on. This deals with how the company values certain assets and liabilities, particularly their warrants. The warrants are a bit tricky. They are classified as a liability and need to be revalued with every financial report. This revaluation impacts the company's reported income. The tables show that the public warrants and private warrants are valued using different methods. Public warrants are now valued using a market approach, meaning they look at what similar warrants are trading for. Private warrants, on the other hand, are valued using more complex models like Monte Carlo simulations, because they are not actively traded. The values shown range from very small amounts for warrants. For example, as of the 31st of March 2026. The range for public warrants was between $0.0006 and $0.16. The median value was $0.035. This shows that the market does not place a high value on these warrants right now. This note clarifies how the warrants are treated. They are considered a liability because they do not meet the criteria for being treated as equity. This means any change in their value directly affects the company's net income. The warrants can be exercised to buy Class A common stock. There are specific conditions for this, including registration of the shares and their trading price. The company can also redeem these warrants under certain conditions. For example, if the stock price reaches $18 per share for a certain period, they can redeem the warrants for a small amount, like $0.01 per warrant. This is a way for the company to clear these liabilities off its books. Here we get management's view of the company's financial health. They reiterate that they are a SPAC and have no operating revenue yet. They talk about the extensions to their combination period, now extended to February 2027. This shows they are still searching for a deal. The planned business combination with Instinct Brothers Co. Ltd. is highlighted. This is a significant development, as it is their current target to merge with. The deal is valued at $200 million. Management acknowledges the going concern doubt. They clearly state that if they miss the February 2027 deadline, there will be a mandatory liquidation. This is the stark reality for SPACs that cannot find a deal in time. This section is important because it lays out the risks. They mention economic uncertainty, volatile financial markets, inflation, and geopolitical instability as potential issues. The military conflicts in Ukraine and the Middle East are specifically called out as factors that could impact their ability to complete a business combination. This is a real concern for any company. but especially for a SPAC that might need to raise additional funds or whose target company could be affected. A significant risk they mention is a 1% US federal excise tax on stock repurchases. This could apply to redemptions of shares related to a business combination. This tax could reduce the cash available to complete a deal. Here, management admits that their disclosure controls and procedures were not effective. They highlight a material weakness in their internal controls over financial reporting. Specifically, they mention a failure to timely close their books and records, a failure to file regulatory documents on time, and an issue with the review of their statements of cash flows. This is a red flag about the company's internal processes and reporting accuracy. As a smaller reporting company, they are not required to present risk factors in this specific filing. However, they mention that there have been no material changes to previously disclosed risks, except for the potential impact of ongoing military conflicts on their ability to find a business combination. They also re-emphasize the excise tax risk related to redemptions. This is just a list of other documents filed with the report, like certifications from the CEO and CFO. Now for my take, Relativity Acquisition Corp is in a very precarious position. Their operating cash is almost non-existent and they are heavily reliant on the trust account. The repeated extensions and the fact that they still have not closed a deal by March 2026, pushing the deadline to February 2027, shows the difficulty they are facing. The fact that they admitted to material weaknesses in their internal controls is also a serious concern, suggesting potential issues with accuracy and timely reporting. They are clearly under immense pressure to close the deal with Instinct Brothers, and the market's valuation of their warrants at such low levels suggests it is not confident this will happen or be successful. My biggest concern is the going concern warning. Companies that are deemed to have substantial doubt about their ability to continue as a going concern often face significant challenges. For a SPAC, that means liquidation is a real risk if they cannot find a deal and close it before their deadline. What I'm actually looking for is any news on the Instinct Brothers deal closing and what the financial health of that target company is like. That will be the ultimate test for Relativity Acquisition Corp. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, hit like and subscribe for more. Join our Discord in the description.